everybody, this is Lee Jackson again, and this is our continuing series on insurance, how to buy it, what kind of insurance, how does it work, things you really need to know. And this time we're talking about health savings accounts, HSA accounts. Now these are championed by President Bush in the 2000s, and they're a newer kind of insurance, and they work similar to a PPO plan, not an HMO plan. And if you don't understand what those terms mean, go look up our videos on those, because they're there to help you. But a health savings account, in theory, remember in theory, works like this. I can take pre-tax dollars and put them away in a savings account that I control. It's in my name, my bank, no one can touch it, and I can pay for health-related items from my pre-tax earnings, like health insurance payments, long-term coverage or long-term care payments, dental, vision, you name it. If it's health-related, I can pay for it, and it comes out of my account, and it's pre-tax, no tax dollars used on it. So that's the theory, and then when I hit a deductible of a certain amount, the insurance company kicks in and picks up the rest for the rest of that calendar year. So the first thing we want to talk about is how much are the deductibles? Well, in the old days, they used to be a lot less than they are today. They've raised the deductibles, but the cost of these accounts are pretty reasonable. So generally, the deductibles start around $5,000 to $10,000. And what does that mean? Well, it means until I spend out of my own pocket $5,000 to $10,000, whatever the number is, it's my nickel. I have to pay for it. Now I can use, again, pre-tax dollars to do that, or I don't have to. You don't have to have the health account. You just know your deductible is X amount every month. Now if you're using a major insurance company, which I would think you would, they negotiate the rate beforehand, which means they make deals with doctors, providers, labs, hospitals, to get you and them both a better rate. So I'm not going to pay full price either way. But they're not going to pay for it until I hit my deductible. So now what happens when I hit my deductible? Well, once you hit your deductible, and it's a yearly January to December 31st deductible, once I hit it, for the rest of that calendar year, everything is 100% covered by the insurance company. I don't pay. So that means I can go to the emergency room, hospital, doctor visits, medicine, urgent care, just about anything is virtually free. So it's more catastrophic, that's true. But if you're older and you really don't have any issues and you don't go to the doctor that often and you're not really worried about the little stuff, this is a type of health insurance you may want to explore. I have clients that have these and they're very, very happy with them. But remember, if you go to the doctor a lot and you use medicine a lot, it's not going to work for you because you're not going to have coverage until you hit your deductible per year. And once you hit your deductible, that is also your out-of-pocket maximum. And what does that mean? That means the two are the same. When I hit my deductible, I'm done. That's it. Usually, that's the end of it. I don't pay another dime for the rest of that year. So if in June I've spent $5,000 or whatever it is, the rest of that year, everything pretty much is free. So your deductible comes into play, but once you hit it, you're done. And all your preventative is covered before your deductible. So that means I can go to the doctor for my checkup once a year with blood and x-rays. If I'm a gal, I can get a pap and mammogram, and I can also get a colonoscopy if I'm over 50 before my deductible, and there are no costs. So you do get preventative. You don't get medicine until you hit your deductible. You don't have emergency room. You don't have urgent care. You don't have doctor visits other than preventative. So that's something to keep in mind. So these are very cost-effective plans for people that like this idea. And again, I have a lot of people that really do like these plans, but it depends. What are you trying to cover? If you tell me I'm trying to cover the big stuff, this is perfect for you. And they're cost-effective plans. So these are called HSA or Health Savings Account plans. Remember, it's your choice whether you want to put a savings account together. You don't lose the money. It rolls over year to year if you don't use it, because people ask me that too. What happens to the money? It rolls over, and it's your money. Now, if you use it for something not health-related, there are big penalties. So it's better to put it in an account. You get a credit card from your bank, like an instant teller Visa card, and you go to the doctor and you pay with that. You go get medicine, you pay with that. It comes directly out of that account. Or you don't have an account, but you know what your deductible is going to be. So this is our new talk on HSAs, and I hope it's helpful. Again, I'm there to help. If I can help you, my name's Lee Jackson. My number is 310-756 5976. Again, 310-756-5976. And these are California plans, and I am an agent here in California, and I don't charge, and it costs you nothing to use me. So if you have a question or you need help shopping, pick up the phone and call me. I'm there to help. Have a great day. Look for more of our video information series on insurance coming at you. Have a great day. Bye now.